A lot of small business owners I talk to, you look at their tax return and it shows significantly less profits than their P&L. But when they go up to sell, that can reduce their value of the business, depending on the buyer and what the bank looks at. If they look at preferred tax returns over internal financial statements.
So when you go to sell, remember that it's always the leverage of the buyer to say, "Well, I'm not going to offer you that much because that's not what your tax returns show." That's just a PE. That's private equity venture leveraging. That's a buyer leverage. So what I always tell business owners to do is do a recast. Do your P&L, do your tax return, save on the taxes because there's nothing better than just more money in your pocket. And if you're legally reducing the taxes, try not to make your tax returns look better so you're paying more tax. That's the old banking issue. People will come to me and say, "Well, I don't want to do that because then I won't show a profit and I can't borrow money." Then you're dealing with the wrong lender because a smart lender will look at everything. So if you're moving, like let's say you've created a C Corp as an operating company and an S Corp as a holding company and an S Corp as an operating company. And you're selling the S Corp. And the owners or a bank or the buyers of the bank are going to look at that S Corp and say, "Well, that's terrible. You have no income there. We're not going to offer you as much." No, you have to look at the whole picture. So I'd say it's the first sign is when you go to sell, if somebody's saying, "Yeah, we're going to go off your tax returns," say, "Sorry, I'm moving on to somebody that is going to look at the whole picture, not just the tax returns."
Yeah.
I mean, if you recast any P&L, it should be what would a buyer be buying? So if you're paying for an RV and you're paying for travel and you're paying for, I don't know, whatever it is, you have to be able to show that segregation in defined manner on your P&L and then show a recast showing, hey, if you buy this, you're not buying that expense, you're buying this product with this cash flow. And as long as you can do that, but a lot of times what business owners do is they have terrible bookkeepers, they have terrible CPAs, and everything just gets mixed in together. And a lot of owners don't even know how to segregate it. They're like, "I don't know what I spent where over the last 5 years." And so that's in the books and records, what we call the bars, books and records, that is critical to your valuation profitability.
Yeah, that makes sense, and especially, it goes back to the planning ahead at least 3 years. At minimum, have very well documented system in your finances before the sale, at least 3 years for that
Yep.
reason as well.